Welcome to Case Study Series in Strategy Case Study by Skilled MBA. The mini-mill disruption revolutionized the steel industry by introducing cost-effective production methods, challenging traditional steelmakers. This shift altered the competitive landscape, forcing established companies to innovate or risk obsolescence. Understanding this disruption is crucial for analyzing strategic moves like Nippon Steel's bid for United States Steel, as it highlights the importance of adapting to industry changes. The mini-mill disruption revolutionized the steel industry by introducing cost-effective, flexible production methods. This innovation challenged traditional steel giants, reshaping the competitive landscape. As mini-mills gained market share, established companies faced pressure to adapt or risk obsolescence. Understanding this shift is crucial for analyzing strategic responses and future industry dynamics. United States Steel, founded in 1901 by J.P. Morgan and Elbert Gary, was America's first billion-dollar corporation. It epitomized industrial might with peak production of 35 million tons annually and over 340,000 employees. Despite pioneering integrated steel production and bolstering infrastructure and military, by the 1970s, it faced challenges from domestic and international competitors. Mini-mills revolutionized the steel industry by initially focusing on low-cost rebar production using recycled scrap. With lower capital and operating costs, they gradually advanced to produce higher quality products like structural beams and sheet steel. By the 1990s, mini-mills such as Nucor offered comparable quality at 20% lower costs than traditional integrated mills. Clayton Christensen's disruptive innovation theory is exemplified in the steel industry. Mini-mills entered with low-cost, simple products, targeting overlooked segments. Incumbents like United States Steel moved upmarket, but mini-mills improved quality while keeping costs low, eventually capturing mainstream markets. United States Steel's slow response focused on incremental improvements, missing the fundamental shift. The global steel landscape is evolving, with United States Steel's market share declining as mini-mills and imports gain ground. Mini-mills, with their cost efficiency and flexibility, are capturing a larger market share, while imports continue to challenge domestic producers. This shift underscores the need for traditional steelmakers to innovate and adapt to remain competitive in a changing industry. United States Steel's strategic reinvention involved acquiring Big River Steel in 2020 for $1.5 billion, enhancing technology and production flexibility. The $2 billion asset revitalization program aimed to modernize facilities and boost efficiency. Their best-of-both strategy sought to merge integrated mills' product range with mini-mills' cost efficiency and flexibility. In December 2023, Nippon Steel proposed acquiring United States Steel for $14.9 billion, offering $55 per share, a 40% premium, and assuming its debt. This acquisition aims to form the world's third-largest steel producer, leveraging Nippon's technological leadership and United States Steel's market presence and mini-mill capabilities, achieving an annual capacity of 86 million tons. Nippon Steel operates in over 15 countries, producing more than 50 million tons annually. Known for its technological leadership, it excels in high-value steel for automotive, infrastructure, and energy sectors. The Global 50 strategy aims to expand international production to 50% through acquisitions and joint ventures, enhancing its global footprint. Stakeholder concerns are multidimensional. National security issues arise from foreign ownership of strategic assets vital to the United States military. Labor unions, like United Steelworkers, oppose due to potential job losses. Political opposition is bipartisan, with President Biden advocating for United States Steel's American ownership. Shareholders face a conflict between short-term gains and long-term national interests. The Nippon Steel acquisition is under Committee on Foreign Investment in the United States review, focusing on national security. Key concerns include military supply chain vulnerabilities, technology transfer risks, and economic security. Previous foreign acquisitions in the steel industry have faced similar scrutiny, with some being blocked or abandoned due to these challenges. Nippon Steel aims to secure a United States market foothold, access automotive customers, and acquire mini-mill technology, diversifying beyond Japan. United States Steel benefits from premium valuation, advanced technology access, and global scale for modernization. This deal accelerates global consolidation, pressures regional players, and may reorganize supply chains. Analyzing strategic alternatives, United States Steel could continue its best of both strategy, integrating Big River Steel and expanding mini-mill capacity. Alternatively, a domestic merger with Cleveland-Cliffs or Nucor offers consolidation benefits but risks antitrust issues. A structured partnership with Nippon Steel could leverage technology and networks, though it complicates execution and may dilute benefits. The United States Steel case highlights key strategic lessons. Disruptive innovation reshapes industries, urging legacy firms to reinvent business models. Mergers face non-market challenges, while strategic industries intersect business and geopolitics. Global consolidation offers opportunities but also vulnerabilities, demanding careful navigation. Thank you for attending. For more real-world Master of Business Administration case studies, reach out via mobile at +91 87553 0795, email at support@skilledmba.com, or visit our website at https://skilledmba.com.